Now, Patrick, so let's define a single family, Patrick, because in the realm of real estate investors, single family means essentially a property that is, in this case, detached, and it has up to 3 units in it, right? It could be a single family, it could be a duplex, or single family plus ADU plus maybe a coach home, whatever the case may be. But the point is, it's a separate piece of land. It's detached, unlike a condo where it's one piece of land and a tower, or multiple dwellings, meaning 5 dwellings or 50 dwellings or 500 dwellings, depending on the size of the condo building. That's what you're talking about, right, Patrick? Which is the single family. And as we can see by this graph in this chart, I mean, this is on the down. This is going down, and this is. I don't see this necessarily changing because the municipalities and the powers that be, whoever they are, they're really pushing for density and maximum density in the urban centers. And that means they got to build up. And that means that single families are going to become more and more and more valuable. And you don't have to look very far, Patrick, to see this. This is like history repeating itself. You look at and if you're in Canada and you want to see where the real estate market is going, look at Europe. Like, go back and look at London, England. Try to find a single family detached dwelling in London, England. Just go try. See if you find one. The odds are you're not going to be able to find one because they don't exist. Because they're a much older country than we are, Patrick. As a result of that, they've gone through this phase already. That's the way I look at this. And if you do find a detached single family dwelling in some of these major populated areas that have a much older country than we are, you'll see their value is through the roof. And the reason for that is because there's just not a whole lot of them. And I think we're going to go through this phase, especially, and some of our cities have already gone through this phase. Vancouver, look at the price of real estate. Toronto, look at the price of real estate. I mean, they are just a little further ahead, but I think a lot of other cities are going to be going through this as well as we go forward.
Well, when we look at the number of, so when we look at this particular chart, we start to see just how few, relatively speaking, in terms of under construction. There's another part to that. When we look at the hopper, when we look at the top of the funnel, we start to see that by the numbers, permits are way down. So in other words, there isn't any kind of work in progress that is coming on board. So this number is not going to change anytime soon. And so as investors, we say, okay, well, what asset class do we want to be in from a real estate market point of view? And if we can get our hands on single family, if we can make the math work, and we can, by the way, the math does work if you get into that ADU, you get into a triplex, duplex, you have to, this is where the grind comes in, JG. That's where the opportunities are, but you have to go looking for them. It's not like you're walking down the street finding these deals, and you're rarely finding them on MLS. The point is that the numbers can work, but you have to look at it from a 2, 3, even a 4-plex kind of perspective. And there's where the opportunities live. And there's not a lot out there, but that's the rarity of it. That's when you look at an asset class. That's why it's
gold. It's gold.
That's why it's real estate gold.
There's not a lot out there. That's why it's gold. And you can see here and this is back to the permits and kind of the intention. If you look at this chart here under the dwellings under construction, really gives you a sense of the big divergence between the rentals, the condos, and the single family. And then you look at this one here, Patrick, and you can see multifamily in terms of dollars, building permits and dollar value, multifamily trending up, going nothing but up, single family going nothing but down, and they're really going in opposite directions now. And I think that this is a good prelude of what's coming into the future, and it's also a good prelude, as you mentioned, to the value of those properties into the future, specifically single family or those smaller detached properties. They're going to become more and more and more valuable.
Well, there's a couple things. The only province right now in Canada that has any kind of construction going on in that space is in Alberta, Calgary being specific to where the majority of that growth is. So there is construction happening in Alberta in that single family space, but they're also, consider that as much as we hear all the optimism around Ontario, and I get it, you're in the space, you can probably speak to it really well. They take and change all the zoning, and you can put, as many units as you can put in, up to an 8-plex, blah, blah, blah. But then on the other side of it, what is the cost of doing it? Why isn't construction exploding? Oh, well, in Vancouver, for example, the development charges alone increased 50 grand. So as much as they brought some costs down, the development charges increased 50 grand. So this goes back to JG. It's like, oh, the government on one side, they give it, and then on the other side, they take it away. This is a problem that we're going to continue to have. It is absolutely not going anywhere anytime soon. And so that's why this asset class remains, by the way. I just wanted to add that part to it because I know a lot of people are saying,
yeah, but look what they did. They rezoned and you can build all of this.
well, you can, but you can't afford to. The math doesn't work and developers aren't going to take it on. And of course, you know, and you've learned the bureaucracy of which you have to get through to get something built is off the charts as well.
Yeah, don't even get me started. Let's not open up that can of worms. It just does nothing but frustrate me, Patrick. Well, what's interesting is some of these challenges that we're all going through is literally changing the makeup of the makeup of our real estate sector. And this is an interesting chart that shows you how much first-time home buyers are down since 2015. We're talking well over 20% first-time home buyers are down. This is and that's why, and Patrick, you and I have been saying for a long time, we're becoming a nation of renters. And this is why first-time home buyers can't get into the market. And I think this is what a lot of people are trying to solve for, is to get first-time home buyers into the market. And they're going about it, of course, the entirely wrong way. The government is only making it worse, not making it better. Let's be very clear. This is what they're trying to solve for. They're trying to get those first-time home buyers back into the market. And you can see repeat home buyers definitely trending up. Investors also trending up, Patrick, especially since COVID. I find that fascinating. Look at the beginning of COVID, boom, a complete reversal in trend where it was trending down in terms of the year over year. And now it's gone completely the other way. And now we have more in terms of percentage change since COVID. Investors are the leading category, which is quite interesting, Patrick.
Well, I think that these numbers are lagging, so I think you're going to see that shift as well. So when we look at by the end, when we start to get these numbers at the end of 2024, you're going to see that dip down quite dramatically, I believe. But we'll start to see. This is really a stark visual, if you will, of what's happening with home buyers, and this is a trend that is not going to go away. Which goes back to what I was talking about when we talked about many times. This market is challenging for investors, and that's not going to go away, but it's equally or more challenging for those individuals who want to buy a home. And so the home buyers, and that's why we have the self-funding house initiative that we're partnering on, is to support home buyers in actually being able to buy their first-time home. But having said all of that, from an investor point of view, it's not for the faint of heart right now what we're going through. This is a part of the cycle that is really painful in many regions, given what's going on with banking and interest rates and mortgage qualifications, finding cash flow, and all the rest of it. But when you look at the upside to being a real estate investor, for those who are willing to go through the grind, who are willing to do the work, make themselves, create that team, take the time it takes to get through all of the chaos and the uncertainty, the upside is very strong in creating a long-term wealth strategy, JG. It's, to me, it's just as plain as the chart in front of us.
Yeah, absolutely. Now, as we go beyond this, Patrick, and we talk about, two of the driving factors of real estate, and you, Mr. Alberta, should I call you Mr. Hawaii today because you're in Hawaii? Maybe
today, yeah, for sure.
But as you know, we've talked a lot about Alberta in the last 3-4 years, Patrick. There's no doubt, and there's two driving factors that continue. And for those that are watching this show, and if they're not familiar, people are interesting when they think about Alberta because they correlate real estate prices, and Alberta's had a nice run up in real estate prices, which has happened in the past before. It's not the first time it has happened in Alberta, but people think that the real estate run up comes first. But there's two driving factors before the real estate run up, and this is one of them, Patrick, which is the population growth, which we've already talked about. Is you can see Alberta's outpacing the rest of the country in terms of population growth. That leads to accelerated real estate prices. And the second thing, Patrick, is more economic activity. And here is a really cool chart you've put together, or not you've put together, but you found from ATB, on the manufacturing sales and the manufacturing sector in Alberta. You could see really since that 2020, man, since COVID, they have just been rocking and rolling, and they're up, in terms of manufacturing sales, like from roughly 6.5 billion up to 9.5 billion. I mean, that's good growth.
Huge numbers. But it speaks to what we often talk about, which people, and I know not you so much, you understand, but ultimately, people may be critical of my criticism of government. But ultimately, to me, this is a very kind of perfect example of what Canada lacks as a country. Alberta is doing. That is in the realm of productivity, of driving GDP. And, on top of immigration coming into that province, they're actually delivering. Manufacturing has, I've said it every show, we need more productivity. Manufacturing is one of those, really key drivers of productivity. And Alberta is really taking that on, whereas we're not seeing that in the rest of the country. So the point of it is this, is that when we look at what's happening economically in Alberta, it continues to be a leader in that space. It's why, as investors, we can be pretty bullish about what's going to happen in the real estate market. That isn't without the cautionary note, JG, which is buy for cash flow. Don't do what many are doing, which is now into a boom market. What are they doing? It's speculating. I mean, gosh, how many times do people have to see a boom market, be geniuses, and then get their butt handed to them because they didn't pay attention? So my point is this: from the REIN community point of view, this is a boom market that's happening in Calgary specifically. We're going to see Edmonton follow likely. And as we go into a boom market, we all look like geniuses. We all are making money on paper, but we have to be very, very cautious through this cycle. And so that, because ultimately we will come down and we'll enter into a slump cycle at some point. And we don't know what the timing of that is going to be, but we have to consider that. So make sure that you're buying right. And yes, Alberta is bullish, and this is one of the reasons why, is because productivity is high.
Should I open up the door, Patrick, that you talked about, and you've shown in many charts before how Edmonton typically always follows Calgary, but you're not sure this time. You're not sure if Edmonton is going to follow Calgary quite like it has in the past. Why is that?
Well, we talk about the long-term real estate success formula, JG, and within that, there is the economic fundamentals that drive. So, for example, immigration, GDP, job growth, all of those things are the kind of the foundation, the fundamentals. But along come these things called influencers. Influencers are things like real estate or interest rates. But the other influencer is politics. And sadly, when we look at what's happening politically in Alberta, there's a bit of an upheaval. When we consider the political policies and belief systems of an NDP government, Edmonton is NDP. Now, when we look into the future of Alberta, guess what? NDP is going to give the Conservatives a run for their money. Now, as much as that's political, so forget about, let's just take politics out of it. The reality of it is that there are very, very clear policies and ways of operating that the NDP has versus the Conservatives. If you believe in that program, if you believe in those politics, then keep investing in real estate the way you do it. But my suggestion is that you pay attention to these influencers that are coming up, because that's where a NDP government will come in and they'll implement, for example, rent controls. Is that a risk? You bet it's a risk. So we have these influencers in our real estate market and in that real estate success formula that we present all of the time, and we have to have a consideration for that. So these are new things that are starting to emerge in Alberta that we have to pay attention to. Edmonton's already all in. I mean, they're NDP and have been for a couple of years now. And so when I look at the future of Edmonton, it makes me a little bit cautious. That's it. I'm cautious, and I think that is healthy.
Now, you talk about influencers, Patrick, and I find that's interesting because if we dug into influencers, a lot of people look at that and they say, well, if it's not an economic fundamental, it's only an influencer. I can still kind of progress. I can put the blinders on. I can still progress. my word of caution, and this has nothing to do with Alberta, but in general, you have to realize that influencers are influencers until they impact their fundamentals, and now they're no longer influencers. Now they're part of the fundamentals.
100%. 100%. And so, we just have to always be aware. Like I say, look at Alberta right now. It's a boom market. We're in a boom cycle. Everything is roses. Everything's awesome. And yeah, there's complaining and bitching and moaning about infrastructure, all the rest of it. But from a real estate point of view, it's a boom cycle. The thing about it is, in a boom cycle, people forget to do their homework. They forget to do their diligence. They forget to risk mitigate because there's these big allowances for errors. But when you get into a tight market, and we see this in Toronto, for example, JG, is that all of a sudden, kind of shit hits the fan and people are in trouble. You look at an absolute meltdown of the condo market in Toronto. We haven't even talked about that. It is an absolute meltdown, and it's only just starting. So that is because so much speculation, not investing. It was speculation. We've said it 100 times. It was more like gambling, and that is coming back to haunt many investors and that whole condo market.
It's all coming home to roost, Patrick. It's all coming home to roost. That's for sure. Now, these last two slides, Patrick, I'll let you speak to them. But one of the things, there's two things interesting happening here. One of them is that immigration, which is people leaving Canada, especially for the U.S., has just hit a 10-year high. And I'm curious to see if there's a correlation between that, Patrick, and this particular chart, which talks about, the adjusted debt levels in Canada. Do you think these things are connected? And maybe you could speak to these things. I mean, you follow this stuff really, really closely, and you do get pretty fired up and passionate about it. So you think these things are connected?
I don't see the connection of, Bank of Canada policy and, people heading south. I think this is a cost of living. This is a tax, depending on what state you're moving into. This is also a lot about boomers getting tired of winter and wanting to take their money south of the border where they can be warm. And I think that's kind of the natural progression of what we're seeing happen in this particular market. So when you look at people moving into the U.S., depending on what state you're moving into, there's all sorts of preferential tax treatment, if you will. There's far better in the U.S. in some states. I think it's weather related, and even if you look at housing, I mean, ultimately, the cost of housing in the U.S. is significantly less than Canada. There's some resistance going on. As I sit here in Hawaii today, I look at it and go, oh yeah, okay, well that bill is not so bad. That $100 or $200 lunch wasn't so bad, of course, and then you add, 40% exchange rate to it, and you go, this sucks. Anyways, my point is I think that's a lot of what is happening is also lifestyle changes.
Now, so then if that's the immigration story, talk to us about this Bank of Canada policy rate and the adjusted debt levels.
Well, so when you look at it, this is classic. This is part of what is going to really continue to slow our economy down. I'm looking at the ultimate, we live in this world, JG, where, we talked about earlier in the show, where we're eliminating so much of the middle class. And so when you start to see the creep, it starts from the bottom up. So in other words, the first to be affected by rising costs are those lower paying jobs, like within the service industry, as an example. And so what's happening with them? They're couch surfing, they're living in one bedrooms and having roommates move in to be able to afford a place to live. I mean, we're seeing the number of people living on the street explode right across the country, by the way. And so what's happening with all of this is the cost of living increases. And part of that cost of living is a lot of debt was taken on in that middle class. So that's all catching up. Disposable income, discretionary income, all of those things get hammered because of the debt loads. We're seeing credit card debt rise because people are actually paying their bills through credit card. And then we have the servicing of mortgage debt. And I saw today, I didn't have the chart for it, but I want to say that the increase in the past 2 years of the mortgage proportionate share of payments in a family is up 64%. Now, 64%. So in other words, you start to see how much discretionary or disposable income is now going to pay debt. What does that translate to? It means we have less money to spend on goods and services. We were for years a consumer-driven economy. Now, whether that be in real estate or boats, cars, or vacations or whatever, because we could borrow money at 2% or 3%. Those days are now gone for the foreseeable future. At this point, we don't know how long it's going to take for rates to come down, or will they ever come back to that point? No. The point is this, is that the debt levels are high. It is going to continue to slow the economy down. So as much as, take immigration off the table, JG, and we would be in a severe recession. Let's just face the reality of what that is. With real estate the way it is, and productivity as low as it is, and the access to consumer-driven buying, if you will, which is what we've done in the past, our economy would be shut down.
It's interesting, Patrick, just how they measure. If you look at, one of the ways they determine whether we're the way they determine if we're in a recession or not is by measuring GDP, which is essentially, total income or total consumption that they're supposed to equal minus savings. But if you look at that, Patrick, and if you take inflation out of it, take inflation out and you take out and make it on a per capita basis, we've already seen that we've been struggling for some time. In fact, it's only if you look at the aggregate number that it looks okay, and doesn't even look good. It just looks barely acceptable. But if you take out the inflation, which contributes, and if you take out the per capita component, it's not a rosy picture.
It is not a rosy picture, and so shine a light and state what it is, and it's bad news. But I cannot stress enough is that when we look at what we're trying to do, what are we trying to do? We're trying to create future wealth, and we're using real estate as a vehicle to do that. For those who are willing to do the work, do the grind, get the education, keep at it, there's huge upside, JG. There always is in these economic times. Hard to wrap your mind around, hard to have the, inspiration and the wherewithal to go through the grind, but the reality is what it is. And we can either deny it, roll up and kind of sit in the fetal position or lay in the fetal position in your parents' basement, or you can step up and keep grinding forward. And that's what it's going to be. And by the way, it's going to get worse before it gets better. And within this chaos is where the opportunity lives. And that's hopefully what we collectively as the Real Estate Investment Network, and you and I can be part of the leadership in supporting people to actually create that financial future using real estate as that vehicle.
I wouldn't have it any other way, Patrick. Chaos creates the opportunity. Without a ton of chaos, there wouldn't be a ton of opportunity. And since I live in the opportunity zone, life's good. Well, folks, hopefully you've enjoyed this episode number 42 of Rein It In. Patrick, thanks for doing this, even from Hawaii. It looks like a great time out there. I hope you get back to the beach, hit the surfboard. By the way, have you went surfing while you were there?
No, I haven't gone surfing. Where we are, there isn't the waves that we want. So this time, but I'll be back. I kind of looked at it and I was talking to Stephanie. I go, we got to get back to Hawaii.
Well, next time, take me with you.
We'll meet you here.
Thanks for watching, folks. Enjoy the show.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.